nkla stock Nicola Corporation. Okay, so this is I'm doing a new playlist that I just started where I'm looking at solvency risks, I guess. I don't know what to call the playlist yet, but it's a kind of a solvency, bankruptcy kind of outlook list on stocks. And not saying that Nicola's at risk of going bankrupt right now, but I wanted to cover a topic. I did a video on the Genius International brands, or Genius Brands International, talking about warrants. And warrants is one way to issue new shares. And Nicola is also doing warrants, and they're also doing something else called pipe investing, which which I'm going to cover. Which I'm going to cover, and then we'll take another look at the stock market here because we're getting some wild pre-market activity in the stock market. But I just wanted to cover Nicola, look at the technicals also, but more of a fundamental look at share issuance and kind of how companies are funding themselves. And I guess, well, Nicola is like the king of memes right now because they don't even have any products. They just have pictures of things that they would hypothetically like to make, and there's some cool looking like vehicle ideas, and they're talking about hydrogen, you know, um, which which I was huge into like 15 years ago when people were talking about hydrogen becoming a real fuel source and everything. Um, it's an awesome fuel source as far as the environment is concerned because I mean you can burn hydrogen and produce nothing but like water and oxygen as a byproduct, like completely clean fuel source. You can store it with like no environmental risk, or it's like an not even flammable fuel source. Anyway, hydrogen's a really cool idea, but there's zero infrastructure for hydrogen at all. Like electric vehicle infrastructure is hard enough, and that's just getting started, but there's zero infrastructure for this entire fuel source, and this company has no actual they have nothing but pictures. They have like a little spreadsheet with some icons and some ideas and stuff. And those are all things that I saw like 15 years ago. And I could go into Photoshop and make a little pamphlet that says all that stuff. Like I could have made a little pamphlet 15 years ago that looks like that. um, this is not even a real company. Oh my God. Okay, so here's what's happening right now with Nicola Corporation is they have two ways right now that they are diluting shares. And one way is warrants. And what a warrant is, okay, so there's stock options where you have the option of, excuse me, you have the option of exercising, an option um, to make a trade on shares. But this is an option is with shares that exist already. But what a warrant is, when you issue warrants, it is an option to create new shares. So the company prints new shares. And so when share dilution happens, I mean, like the owners and the major shareholders in the company are going to have a smaller percentage share in the company because they're issuing new shares to other people. But all of the existing stockholders, when you issue shares, including whoever's invested in the company, lose percentages of their ownership of the company, and that goes to new people that are buying shares. So, I mean, basically, they're just printing new shares and selling them to new people, and they're taking cash, and the people holding existing shares are losing percentages of their shares. So, stock dilution sucks for anyone that's holding the stock. Um, and so there's like an IPO, like you just announce like you're selling shares of the company. Like that's kind of a transparent way, and it usually happens at the beginning of the company. But people will sometimes do another kind of IPO or a share offering, and it's regulated by the SEC, and everyone knows it's happening. But there's a couple of sneaky ways to issue new shares that people don't talk about that often. And one way is you can pay your employees with stock options, and you're creating new shares, and then when they exercise the options, those shares actually become active in the public market. And then, as we covered in the last video, with warrants, and this is what Nicola is doing now. So, I mean, Nicola, wow, look at the prices. Okay, so back here, when it was at 2030, something like that, um, Nicola has started issuing warrants, and a warrant is similar to the stock option, like I mentioned, but it's not shares that already exist. They create new shares when you exercise the warrant, and those shares are tradable after that. Those are new shares, and everyone that has existing shares, their percentage ownership of the company decreases. You're creating new shares. It's like money printing, it's share printing. And so when the company blows up here to a crazy stock valuation, what we have going on with Nicola is a few things at the same time, where they're issuing warrants that are down here at these prices, like $25, $30, something like that for a warrant. And there's only certain trading platforms where you can purchase and trade warrants and things like that. Whereas like on Robinhood, you don't see anything like that. But you have the stock price, whatever, a few days ago, trading at almost 100, almost $100. And the warrants are trading at like 25 or $30. And so a warrant is a share that you can have at a future date versus the shares that are trading right now. But also, in addition to the warrants, which when people start exercising the warrants, it's creating new shares. But in addition to the warrants, they did a huge mess of pipe investors. And yeah, I don't need to switch over to the article for this. The pipe investors, it's a private investment into a public entity, or sorry, public equity. Private investment into public equity. Anyways, it's getting. I guess if you look up pipe investing, they say it's basically the sort of the last resort for raising cash for a company. It's supposed to be like a really bad deal to do that, but all it means is that you are selling shares, new shares. So you're creating new shares, you're selling them to private investors, and they can't trade those shares for a set period of time. And so it's pretty similar to warrants, where you're creating new shares, but they're not on the market yet. And they're doing both of these things. And there's a huge, huge mess of these. It's June 20, where all of these, the pipe investors will be tradable. And so the actual amount of public shares in Nicola is relatively small. I forget the percentage. I think it was less than 10% of the shares that are actually being publicly traded. But when the pipe investors, the period expires on June 20, starting on June 20, a whole mess of new shares will be available to the market, and all of the existing shares will start getting diluted, and they can start selling there. And I heard that the pipe investment prices were about $10 or something. And so now, I mean, it's trading in this range up here around 60 or something. So that's like a 6x if they come onto the market at this price range, where they can just start selling a mess of shares, and the actual shares available traded on the public market is going to go. I don't think it's quite 3x. It's like somewhere in the 2 to 3x range just from the pipe investors. But there's also warrants. So they issued a ton of warrants, and at any time, I mean, if you buy a warrant at 35, you can exercise it whenever you want. And so you could buy a warrant at 30 and they can exercise it at 60. And that's a new share that's available to trade on the market when they exercise it. And so Yeah, basically, this is a bunch of ways that you can dilute the shares. You create new shares, and the company gets money, and then there's just more shares of the stock available. And it's really the like for the company and the major shareholders in the company, it's okay because they actually own the company, you know, and they get paid by the company, and they do lose percentages of the shares. But for the people that are just holding the stock, especially people that buy in at, at a high price, when you buy in at a high price and then your shares start getting diluted, you're losing percentage of ownership. And most of the time just with warrants, like if the warrant prices are down here and the stock's trading up here, generally the stock will come down and the warrants will come up. Not exactly in like a symmetrical triangle. Although that's what it's kind of doing this time. It's just kind of like this. Um, so yeah, that's just kind of a look. I mean, to me, this entire stock is just a joke. Like this company has a market cap bigger than real auto companies like Ford and stuff like that, and they don't even have products yet, and there's no infrastructure, and they're not profitable. Nothing. Like this is not even a real company. They just have like pamphlets, and and you can see, uh, just kind of looking back at this chart, and just on a technical perspective, when you get this kind of descending bubble, when you get a little pop and a bubble, quite often you get kind of a flat floor. And I draw this shape a lot, but when you get this kind of rounded descending shape and a flat floor, that almost always pops down. It pops down to a floor, and it's already happened once with the stock here. And so I mean, just doing like technical analysis on just this kind of stock shape without any knowledge on the on the this company. That's just a general kind of thing that happens when you get a move up and you get this rounded. It's not really a pennant. It's kind of a descending. I guess you could call it a pennant, a technical analysis, but it's sort of a descending pennant with a flat floor, and that usually will drop down. Uh, and once it lands, then whatever. After that, it's just normal trading. But that's, I mean, it's not quite flat yet, but we'll see if we get that kind of shape here. And it's still about another week before the warrants hit the market. And so usually what you get is the volatility, it just calms down, and then it goes boom. It just drops onto a floor, and then you get a little flat. Um, so that, I mean, that's a best guess from like what this chart's going to do. And then like the 20th is when right now people are already trading warrants, and so the warrants have been trading up and the stock has been trading down. So you're already getting that kind of a pinch from the warrants. But then on the 20th out here is when those private investment, the pipe investors are allowed to start selling their shares, and it will more than double the amount of available shares. And the profitability of them selling those shares at this price is really high. It's like 6x or something. So this stock is incredibly dangerous right now, and in the short term, it's really dangerous. It's doing this consolidation kind of technical shape, but long term, I don't even know. This is not even a real company. They don't even have anything yet, and their market cap is insane. I don't really understand this thing. Um, I mean, from a fundamental standpoint, this is just nonsense. But in terms of just kind of gambling and trading and things like that, that's kind of what I see on the chart right now. As I see this shape, that's gonna. It's still. I think the floor is probably here. I think it's gonna. I think it's gonna do this and chill out to the about the where are we? Yeah, I think the 20th is about here. That's what I think. I think that this is a descending shape with a floor about here. And I think that we're gonna just see this thing decrease in volatility until it goes pump, and it'll just drop on the floor. And that's what I see coming on this chart, the most likely scenario. And the 20th is the date for it to drop because that's when a whole new mess of shares are going to come on the market. And if it only drops to 37, that's still extremely profitable for the pipe investors that are holding, a $10 share that they can't sell yet. I mean, it has to go. Wow. It has to go way, way down here below the moving. I mean, they'll still be profitable way down here. So I think the downside on this stock is nasty, and I think it's going to be a minute before it drops, like another week or so. And also, I heard that the market's not open yet, so I can't really look at the put option prices. But I heard that the cost of buying puts or shorting this thing is really, really expensive. And so, yeah. Anyway, just not investment advice, but be really careful with with the really expensive companies that have zero revenue and they're diluting shares like crazy. And it's just a mess. The fundamentals on this thing are absolutely nonsense. Like, it doesn't even make sense. Um, but they put it up as like a hot stock on Robinhood, and people are just buying it up. And oh my goodness! All right, that's enough on Nicola. I mean, this is the whole company is just a scam. I think, as far as I'm concerned, I want nothing to do with this thing. And yeah, I mean, even shorting the thing doesn't even make sense if the options are so expensive. Like, you're not even gonna make money shorting the thing. So let's take a look at the general market. It started to break down again. Okay. Oh, okay. Yeah. All right. This is nasty bearish. So we've come down, and we started to break down at the end of last week a little bit more than I thought. I thought that we would get like a good channel up here, maybe out to Wednesday or something like that, but it didn't do that at all. It broke down right back to the moving average, and now it's broken. It back tested the moving average. So this is super bearish. And we don't have this is a breakdown over, yeah, this is a breakdown on off hours, which is extremely different activity over as compared to the last like 2 or 3 months. The off market activity has been like 90% bullish, and then over the last week, off market has been, well, this is off market as well. So, but right here, the aftermarket trading or the pre-market trading going super bearish is pretty nasty. And this that's not what I was looking for here. When we got this shape, I thought we might get like just might get a flat here and like a five wave. I was looking kind of for a flat and a five wave bounce off of this to see if it was going to get bearish or not. I didn't expect it to get bearish immediately like this. But this is nasty bearish. Like, this already dropped, tested, broke, and back tested this thing. It's bad. Okay, let's look at DXY. Yeah, so I, I closed a few of my shorts when it dropped last time, and I was trying to look at where to reposition. And I guess I'll just sit on I have a long vol, I have short like IWM and XLF and stuff like that. Those aren't trading yet. Let's take a look at the dollars, the stuff that's trading right now. So for the last, I think, about 2 months, the dollars have been trading inverse to the whole stock market, and that looks like it's continuing now. We had this really really brutal push down in the dollars that correlated with the big spike that we got before that drop, and now dollars are pushing up, and this is just bullish. This is just bullish on dollars, mostly against euros here, and it just looks like another bull pennant here. So it looks like dollars are pushing up and stocks are pushing down, and the yen was an interesting one because it made the move before the stock market made the move. So I'm going to keep taking a look at the yen, although it hasn't been swinging like inverse to the market exactly. But I like looking at the DXY and the yen. And so, okay, like if you follow Brent Johnson, he talks about the dollar milkshake theory, where there's dollar demand across the world, and now everyone's saying like there's too many dollars and there's no dollar demand, and that's wrong. Like there's definitely dollar demand. People have a ton of debt. 70% of the world monetary supply is dollars. People owe their debt in dollars, and everyone in every other country around the world that has to pay their debt in dollars has to trade their currency for dollars just to pay their debt. And so that's dollar demand. And I did hear a really good argument that the sort of the weak, I don't know, the Achilles heel, I guess, of that theory is that people don't actually pay the debt. Like eventually they just go bad on the debt. And that's probably true. Like that's what always happens when the debt gets insane. The dollar gets way too strong. Like people just default. There's no way to pay it, and people will default. Um, but they're not at that point now. And so until we start seeing defaults, I don't think that's going to play in. I think that there's going to be dollar demand, and as long as the DXY is trading opposite to the stock market, yeah. This is a weird one though, because if you listen to Brent Johnson, he is projecting that the dollar and the stock market go up at the same time as the milkshake theory kind of plays out, as the DXY pushes up, as the dollar pushes up against other currencies over, and this is over like the next 2 years or something like that. So this kind of activity where the dollar and the stock market are inverse is basically his theory hasn't started happening yet. Um, and so right now, until the fundamentals switch, where other countries start getting in a ton of trouble and inflating their currencies out against the dollar, I think we can just use the DXY as a general indicator inverse to the stock market. And so this just looks like a bullish continuation on the dollar here, which would be bad for the stock market. And I don't know if we're getting trading in any of the metals and stuff. Oh, silver. Oh, wow. Okay. Um, yeah, that's a really bearish. That's a really bearish top for silver and a gap. So silver. When I look at silver, it's kind of an inflation play. Like if you get real inflation in the dollar, silver should do really well, but it needs a positive commodity environment, and it needs inflation to do really well, because it's mostly a byproduct of commodity mining, but it's also a monetary metal. So silver is kind of a tricky one, um, but yeah, this kind of breakout in silver was sort of an inflation indicator, like what's going on, but it didn't really make sense with the other indicators. And silver's breaking down, and gold is not breaking down; it's just sitting there. Okay, so I mean, just looking at the monetary assets and looking at the bonds right now, the bond yield curve is flattening again. It went steep and it's flattening, and so sort of the long recovery scenario is declining this week, and um, yeah, the dollar's pushing in the wrong direction for a recovery right now. The S&P is breaking down more than I thought. Already. That's not the move I thought it was going to do right now. It's breaking down pretty hard. And then the the small caps and the XLFs are kind of more what I'm looking at longer term, because the financials respond really hard to the interest rates, and so very low interest rates long term is terrible for financials. And so everything that the Fed just said should be like awful for the financials. Um, and the financials are kind of an indicator of market activity on their own, on the strength of the economy. But those super low interest rates are just bad for the economy in general. And they're bad for financials, but that doesn't automatically mean it's bad for the stock market, because loans are way more available in general with super low interest rates. But as far as shorts, like this is what I have short right now. I have XLF shorts, because of the interest rates dropping is really bad for financials. And I have, well, this is not investment advice, but I have small cap shorts right now because the solvency issues in the buybacks, basically. The small caps are not doing buybacks, financials are not doing buybacks. And for the financials, the low interest rates are brutally bad. And for the small caps, the solvency risk is a huge deal, because they don't have the cash on hand to handle a long term, solvency squeeze with low revenue, and they don't have the kind of loans available to the bigger companies. So just basically the solvency risk on the small caps is super high, and the low interest rate risks on the financials is really high. And those, I mean, this move surprised the crap out of me on both of these. The small caps and the financials popped like way up above the trend line into entire bull market territory over here. And so, the last 2 weeks, I'm like, all the fundamentals are bearish, but all the technicals are on the bullish side. And so it's a really confusing kind of thing. The last 2 weeks is just a mix of indicators that didn't make sense. But now everything's bearish. The the technicals are bearish, both in Elliott's and on the moving averages and on the financials. So when you start looking at the financials, you're getting more into fundamentals. But I mean, obviously, like the PE ratios and all that stuff have been nonsense for several years, and that doesn't indicate an immediate kind of movement in the stock market or something like that. But I think the thing to look at right now, and I've been talking about this a lot, and this is a big Raw Paul thing, is to really follow the bond yields, because they kind of lead the market and tell you the bonds and the interest rates and the Fed funds rates really tell you where things are. And right now, they started to steepen last week, and it started to look okay. And there's a huge reversal in everything, in the bonds and the monetary, like in the FX pairs, and and now we've got the yield curve flattening again, and things are starting to break down. So I mean, you can see here, this blue line is the 130-day moving average. And so if you're in a bear market, that will keep the action to the bottom side of the moving average in general. Like you can break it, but you usually get rejected out of there pretty hard. And then if you're in a bull market, it keeps most activity to the upside, and you can break it, but it usually pops back up. And so for a bear market outlook right now, which I mean, just this move right here is like, that's a bear market until proven otherwise, without even looking at anything else. But we did this run way over here, all the way up into bull market territory, north of the moving averages, and so that's a huge thing to look at here. And I'm actually surprised, regardless of kind of bearish fundamentals and things like that, I'm surprised that it broke down as much as it did that fast. I thought we were gonna get So we're gonna get a little more. I was looking for a spot to kind of position some more shorts here. And I sold some shorts in here, and I was looking for a 5 wave maybe this area or something here before it broke down again. But now, all right. So I guess just taking a look at the bubble model. For me right now, this area where we are now is kind of no man's land, and well, it was no man's land north of that moving average. Now it's kind of back testing it. It's back testing it, and that decreases the odds of getting back up here and testing this by a lot. Like when we did this, when we did a good bounce off of this, I was thinking it was almost like 50-50 that we get back up in here and try to do a second test of this thing. I don't know what the odds are now. I think it's like after breaking down here, I think it's less than a 25% chance that we get back up here to test this again in the bear market case. Because a double test of a trend line like this is pretty common. And so just kind of looking at the bubble model, if you go back in my channel and look at like the Nikkei and the Great Depression kind of, when you're on the backside of a bubble, you build these long-term trend lines. And so this is a 2-year trend line here, the Volmageddon line that goes back to the bottom of the 2018 bottom. This is a 12-year line here. This is the financial crisis bottom. And this is a bull market, support line that's 12 years. And then way down here, we have like a 40-year support line. That's really like the floor of the everything bubble. The everything bubble is like 40-year bubble. And it has 3 different increasingly steep trend lines. And we broke this Volmageddon line and dropped out of here. And so we did like a little test, and we did a double test of this thing here. And so, I mean, this is really, really fast. You usually don't destroy trend lines that fast, but it got down here and back tested this one and dropped out of here. So I thought that the Volmageddon line was done and gone already because we already broke down to the next line. And I thought that we were on the backside of the bubble and we already destroyed the first trend line. But then we just blew all the way back up to it over here. And so I'm like, oh, okay, wow. All right. So we're just on the first trend line. We're on the first trend line, and it's very common to double test it before you actually break it and get rid of it. And so, yeah, so from here, I'm like, I don't know. I mean, you're looking to either backtest this one or backtest this one. And I don't know where we are yet, but right now it looks like we already broke down. And so I think the odds that this is actually destroyed, and forget this line is pretty high at this point. Like that's it. Like we just hit and terminated that trend line, and that's a tangent. That's a 2-year tangent line of a bull market wave, and this terminates the tangent line, and we're done. I think that's the highest probability right now, just from pre-market today. Yeah, because if we backtest and break and drop out of here and cut this line, then we're not even dealing with this line anymore. Then we're on to the next line, and we're on the back of the bubble. And yeah, as I just pointed out, the next line below that is down here. It's like 1200 range. So if you take a look at my model of the Nikkei and stuff like that and the Great Depression, you can see kind of the shape that you get on the backside of a bubble. And those other bubbles didn't have lines that were quite this close together. And I haven't seen a single bubble where you break a second trend line and then go all the way back to the first trend line. So this is I'll do some more bubble research and see if I can find another example that does some stuff like that. But generally you test the line, and we got a test here, we got a double test here, and then we got a big swing and another test here. Yeah, so I mean, yeah, this looks like the backside of a bubble. I mean, I think this is completely a bear market on the backside of a bubble. And Yeah, the US can print dollars and stuff like that. And like if they do MMT, they can sort of bypass the financial system. It kind of makes things a little bit more complicated than some of the previous bubbles where, you know, the currency was backed by gold or something like that, where there's less kind of flexibility to screw around with the financial system. Because this whole thing is really just a map. This is really just a map of the expansion and contraction of the financial system. And what you get is a 40-year expansion of the Eurodollar system, which is it's the international monetary banking system where the international banks were lending out dollars to the rest of the world, and it just expanded and expanded and expanded across the entire world to where now the US dollar is like 70% of the entire world monetary supply. And then just right here, you just bang, you like hit a wall where you cannot expand the dollar any farther, and you hit a big contraction. And this is a huge contraction in the worldwide dollar, and it's called the euro dollar. But it's just the US dollar issued by international banks, basically, that hit a wall and it couldn't expand anymore. And that's when the Fed jumped in and said, well, we can print dollars, so that's what we're going to do. We're gonna sort of bypass the eurodollar system that's failing. Like the Fed is just bailing out the entire worldwide eurodollar system. And I mean, you see the balance sheet going north of $7 trillion. Like they are just pumping money into the international monetary system and sort of overriding the failing international banking system. Um, and so that's why the markets are really complicated to figure out, is because if you were just mapping the international banking system sort of contracting, I think it would be a lot easier. But now the Fed is kind of jumping in front and bailing out the eurodollar system. And so it's not like, when the US banking system sort of contracted against gold. Like you can't go print a bunch of gold and change the rules. But right now, like the Fed can print dollars, and so there's still limits to what they can print because if they cause inflation, they're going to have to back off. But right now, it looks like there's not inflation indicators, I mean, from their perspective. So, yeah, so this is, it is a complicated puzzle right now. I mean, it has like 80% of the fundamentals of the Great Depression, except for the one major fundamental is you can't print gold. In the Great Depression, that was backing the money supply. But right now, the dollar is backing all the worldwide money supply, and you can print dollars. So it makes it a really complicated mess. And yeah, and it's just really interesting. Um, but as far as just mapping the trend lines and all of that without jumping into the huge thing, it's quite common to double tap lines. These bull market support tangent lines. When you're terminating a tangent line, when you're ending the wave, and you're getting out down to the next line, it's very common to hit them twice. And you see that in a lot of bubbles when they unwind. And so I'm a little bit skeptical of this single tap right here as a termination point. And if we had started moving here, I would have said it's probably more likely to double tap the thing. Um, but now, well, let's see what the trading action looks like today. But breaking down under this is really, really decreasing the odds that we get up here, even in the bearish case. And breaking this would make it super, super unlikely that we get back up into this range. I think once we break this line, we're not going to get back above it, unless the money printing rules make this thing look way different than other kind of bubbles unwinding. But I don't think so. I don't think so because they always do that. I mean, governments when their currency kind of bubbles are popping, it's a sovereign debt bubble. Like that's what these bubbles are. It's a sovereign debt bubble. That's what it is all the time. That's what Japan printed like madness, when their bubble was unwinding and they intervened and they've been buying up all the stupid little tricks, that you play when a bubble is popping. Don't stop the bubble from popping. It still pops, it still unwinds, and it unwinds with this pattern just like this, where you break and backtest these bull market lines, and you go down to the next one and you backtest and break it. But right now, we haven't gotten below the 2008 financial crisis line and backtested it yet. Like, this action was completely ignoring that line, and this is all the action is still about our first line here, and just seeing if this did terminate the first line basically, and if we are moving down to the second line. And so what are we on, like 3 or 4 months or something here? It usually takes a few years kind of to unwind a bubble. So like in the case of Japan, it took, I think, 3 years kind of to wind down off the bubble, but then uh, all of their intervention and all of their money printing and all of their buying equities and buying ETFs, and they've been doing every single thing in Japan like the whole time, just resulted in like a 20-year bear market after the bubble unwound. It did not blow the stock market up to infinity for them to intervene like that. Um, so yeah, this is kind of the puzzle right now, is looking at the currency pairs and looking at the dollar. The dollar is the really tricky thing, because the dollar is the standard for all the other world currencies, but America can print the dollar. So that's what makes it extra confusing, trying to analyze these charts. And still, though, looking at the US stock market versus all the other stock markets, if you look at the FTSE, if you look at like the German stock markets, or like even if you look at India or something like that, like they're all following the same pattern. This pattern is on every stock market in the whole world right now. And this is the expansion and contraction pattern of the international monetary system, which was the euro dollar last year, and now it's the Fed bailing out the euro dollar system. I guess basically that's kind of the look for right now. And oh, I don't know. Let's take a look at the VVIX or something like that. I don't think it's moved yet. I think this is still where it was. Is VIX moving? Oh yeah, VIX is getting action. Okay, so yeah, the volatility is still blowing up, and so that just indicates that we could get some bigger swings kind of in the price action right now. Um, but in general, for a bull market, you want to be kind of below 20, and for a bear market, you want to be kind of above 20. And so we are getting down to sort of testing bear to bull range on the VIX, and then just blew back up into bear market. Um, yeah, so absolutely every single indicator is bear market, every single one right now. And yeah, and so I guess, man, it's really complicated to know. I don't like silver. I do not like silver right now for several reasons. Well, one, the tech kind of is breaking down, but right now, with the bond rates and everything low, that is not an high inflationary outlook. So I only like silver in a high inflation environment. And so I like to track silver to see if it's indicating inflation. And it did a big run here, which was really confusing, but it doesn't look like we're in a high inflation environment now. It looks like the Fed is fighting against deflationary environment, and gold should do okay in a sort of a deflationary environment. Gold should still be fine. But if we get a sell-off, if we get like a liquidation sell-off, gold will sell off with everything else. And so there's downside risk on the gold. And I'm not holding any gold right now at all, actually. Um, and my goodness, man, there's nothing that really there's nothing that really is safe or makes sense yet, really. I mean, I'm just sitting on some solvency kind of shorts for right now, and a bunch of cat. I'm mostly cash, just dollars, and I think dollars are gonna be one of the best things in the short term and the least crazy. Um, okay, so what was this a Nicola episode? Okay, so I've run off into nonsense land again. Nicola is doing a bunch of crazy nonsense, and that is the kind of stuff that I'm gonna make a playlist to watch out for all that kind of stuff. So issuing new shares like directly or paying employees with new shares, yeah, like companies do that over time, but right now during a crash, like paying some employees with some stock options and stuff like that isn't going to be a big factor. But these warrants, when companies issue a ton of warrants, those are new shares, but they have not hit the market yet. And the same thing with those pipe investors, private equity, new shares. They've issued new shares, but they haven't hit the market yet. Um, so that is a huge share dilution kind of thing. And I guess just looking at the shares, we had 12 years of buybacks where there's less and less and less shares on the entire stock exchange. And right here in this liquidation rip, the stock buybacks in every other sector but infotech have gone low or to zero. And now we're switching into people issuing new shares, not buying back shares, making less shares. Now they're issuing new shares and diluting the stocks and trying to raise cash. Um, and now solvency is a huge risk. You have a bunch of companies that can't get loans and they cannot make revenue, they can't make profits. I mean, everybody knows all these companies are unprofitable and everyone's like, well, whatever, the stocks keep going up, so who cares about that? But it matters now. It matters now if they cannot get loans and they can't pay their debt and they're issuing new shares to try to get enough cash just to pay their debt. That's not going into doing anything good for the company. It's just to try to keep the company from going bankrupt. Um, so just kind of share issuance, I think, is a huge issue in the solvency thing. And then also the liquidity. I mean, we had a huge liquidity push from the Fed here when the international banking system froze up, but they haven't increased, they've decreased the amount they're printing, and the Treasury has increased the bond issuance by a huge factor, like 4x over this time period. And so that takes liquidity out of the market when the government's issuing bonds because they're taking the liquidity for government spending, and that's probably going to increase over the next year or two. That should increase a lot more because the U.S. government is looking to do infrastructure stuff now. All of a sudden, now that we're in a crash, they're going to start doing infrastructure. They haven't done any positive infrastructure stuff in like 20 years, and now they're going to start doing it. Great. So um, that's going to take liquidity out of the stock market as well. Um, and that's kind of the look, I guess, is the bonds, the liquidity, the stock issuance. Those are the things that are really going to drive the market. And that's what I'll be covering. And this playlist, if you go check out my, I don't know what I'm going to call it, solvency or bankruptcy kind of watch playlist, I'll be talking about the companies that are issuing a ton of new shares and that have cash balance problems. And Nicola is definitely on that list. Um, and they don't even have products or revenue. They just have a pamphlet and a bunch of debt. And so be careful out there, and please hit the like button, and I'll check in soon. Cheers.